The bell isn't going to ring itself. The art of uplisting, cross-listing, and microcap IPOs. And it really is art. As the market has shifted and the regulators have cracked down a bit, it has become increasingly challenging and complicated to get deals done. So we're going to talk about how to be proactive and how to actually get deals over the finish line, and hopefully spend a little bit of time talking about 12 key points that are very important in today's market, and then take some questions. Well, just a little bit about the firm, 30 seconds. Again, my name is Joseph Lucosky, and I'm the founding and managing partner of Lucosky Brookman, and we are a corporate boutique firm located in the New Jersey, New York area, and we are hyper-focused on the microcap and small cap space, mainly doing capital markets transactions, M&A transactions, SPAC, de-SPAC, lending, other general litigation and securities matters wrapped around the micro and small cap industries. We are hyper and laser focused. And as this says, we are relationship focused and most importantly, results driven. And we have a presence here on the West Coast and mainly in New Jersey, New York. And we also have many clients overseas in Canada, Israel, Australia, and other locations. So before we get into sort of the market trends and what's really going on with NASDAQ and the New York Stock Exchange, I want to set the stage a little bit just about the listing requirements. This presentation is going to be different. We're not going to talk about all of the rules and regulations and go through, how to do a deal. If you have good advisors, good lawyers, good bankers, they will walk you through that process on your deals. What I want to talk about today is the state of the market. What is driving the market and what is holding up the market, and go through some of these key points so you can then go have takeaways to go back to your deals, your clients, your transactions, and hopefully get transactions closed and over the finish line. So let's just set the stage. NASDAQ and New York Stock Exchange, the two premier higher listing exchanges here in the US. Going through the listing requirements, I think this is key, and we're going to cover these very quickly. Remember, they're very similar. NASDAQ and New York Stock Exchange, both you need a shareholder's equity. For NASDAQ is 5 million, New York Stock Exchange is 4 million. You both need a qualified share price. Again, generally speaking, without exceptions, there are some exceptions. Share price is $4 and $3. You need a requisite amount of shareholders, pretty similar. And you need a public float of about $15 million. And this is really a criteria that trips people up on deals. We're going to get into that more later. And then finally, there's fees. You will see that they're pretty similar depending on size and shares and other criteria. NASDAQ has generally been a little bit more flexible with their fee structure, meaning you put a little bit down up front, you pay the rest before pricing. New York Stock Exchange a little bit more over the board. But these are the basic requirements, and this is going to set the stage for our conversation today. So let's just talk briefly about the listing process traditionally. Traditionally, NASDAQ has been very friendly and welcoming and willing to take applications up front, whereas the New York Stock Exchange has been a little bit more discerning, meaning they vet you a little bit more before you're able to actually make an application formally to New York Stock Exchange, within some exception. The listing requirements, again, comparatively, for NASDAQ have been a little bit more restrictive historically. We just covered that, a little bit less in some of the qualifications. And the New York Stock Exchange has historically been a little bit less restrictive. With respect to deal making, traditionally, they have both been pretty streamlined, meaning NASDAQ and the New York Stock Exchange have been pretty good about getting deals through the process. And finally, pricing, again, both have been pretty friendly. However, in the last year or two, this market dynamic with respect to the two exchanges has shifted. And we call this the listing process disrupted, because this has been in the pipeline for a very long time. But last year, in about August or September, I'm sure a lot of you have heard, NASDAQ took a pause. It was affectionately known as the NASDAQ pause. And what that did is, because a few deals in the marketplace have had massive run-ups and have come down, in swing of their trading, NASDAQ decided to take a pause. We're going to talk a little bit more about this later, but I want to just let you know the effect of the pause has really been that the two last categories, the deal making and pricing, has forever changed within the exchanges. Not so much on the New York Stock Exchange side, but mainly on the NASDAQ side. So for example, deal making has become less streamlined. And what I mean by that is that the requirements needed to get your file cleared, your qualitative and quantitative requirements, have become more challenging with NASDAQ since August, September of 2022. We're going to talk a little bit about them here in our additional considerations. And then the pricing has become less friendly, meaning there's new concentration and distribution rules. They are taking a harder look at underwriters and where they're placing their securities, who is in the syndicate. They're even going down to the retail level. Where do people have accounts? Where are they located? What geography are they from? Where do they live? It is very, very restrictive, or as we say at times, less friendly. But now that we've set the stage between generally covering the listing requirements and some of the differences between NASDAQ and the New York Stock Exchange, I want to cover 12 points starting from this moment. These are the 12 most important cutting-edge market-driven trends in our business. We're going to talk briefly about some of these and then go to the next slide because unfortunately we only have 25 minutes. And I could talk probably for 3 days on each of these. But here under the additional considerations, and this mainly relates to NASDAQ. New York Stock Exchange has not really had this problem as much as NASDAQ has. But has anyone here, I'm sure there's some bankers in the room, done a deal and you hear about anchor investors, right? Anchor investors are normally good. People like anchor investors. They anchor a deal. They give people confidence, other investors confidence that deals can get done. Well, we're not sure if NASDAQ likes anchor investors anymore. If you ask them, they'll say they do. They have no problem with the anchor investor. But we know from being in the trenches and doing numerous deals, you have to be careful on your limits on an anchor investor. And we're not sure where that is. Is that 10%, 20%, 15%? It seems to change in every deal. There's no hard and fast rule. But if you're working on a transaction and think you're going to have an anchor investor for 50%, which again, for the last 100 years has been an amazing thing, well, you need to think a little more about that because there are new rules and around the anchor investor concept. Another thing that is really different between the NASDAQ and the New York Stock Exchange is this approach to leakouts. How many times have we talked about on transactions where you need $15 million of public float? That was a requirement we talked about a few slides prior. Well, NASDAQ doesn't give you credit for public float if any of your legacy shareholders, bridge investors, conversion investors are leaked out or locked up. New York Stock Exchange is a little bit more lenient on the leak out concept, meaning you can count those shares as public float. It's becoming a big issue with NASDAQ. Another issue that has come up, especially for the companies that want to cross-list or uplist who are already trading, if you have to do a reverse split that is too deep, too large, sometimes NASDAQ now will not allow you to do a simultaneous reverse split with a pricing on NASDAQ. They make you wait to see how the stock will trade. And we know as deal people, time is the enemy. So if you do a reverse split and have to wait 5 days to list on NASDAQ, depending on your shareholder base and how much they love or don't love you, you could find yourself below the minimum share price of $4 on NASDAQ. So if you're going to do a reverse split of 1 to 50, NASDAQ may make you trade for 5 days. If you do a reverse split, 1 for 100, they may make you trade for 10 days. Again, huge risk in the marketplace now dealing with NASDAQ on some of these issues. Also, NASDAQ has these burn rate rules that, generally aren't written down and you really can't find anywhere. You know them if you're a practitioner and you live and breathe this stuff. But they're very quirky rules about what counts and what doesn't count and how that hits your shareholders' equity, your minimum requirement to get onto NASDAQ. Remember we talked a few slides ago about having a minimum shareholders' equity of $5 million on NASDAQ. Well, if you go through these burn rate calculations without add backs and other situations, you may not have $5 million. On the face of your financial statement, you may qualify. But after you run through NASDAQ's quirky formula, you may not qualify. And it's important that you run through these exceptions and try to figure out on paper prior to launching a deal. Because NASDAQ will come back and say, hey, you may qualify on the face of the financial, but we're not going to let you through because you have to apply this quirky formula. But the biggest change over the last few years has been the concentration and distribution rules that NASDAQ and FINRA and others have come out with and have been implementing and enforcing. So, and we're going to talk in the next slide a little bit more about this. But concentration and distribution, when you're doing a transaction and your banker is saying, hey, we're going to bring in these great investors and we got awesome institutions, and there's 30 of them, and they're all going to put in, 100,000, 200, 300,000, along with an anchor investor. NASDAQ's going to go through and figure out in their own minds, in their own formula, if they like or don't like your deal based on concentration, who's in the book, how much do they own, and then distribution. How widespread elsewhere are shares through retail or syndicate. And then they're going to come back and say, we like this or don't like that. And there's a mad scramble in most of these deals to fix this book over and over and over to get to a pricing. It's the craziest, most frustrating, maddening thing on the planet for a banker to go out there, spend their time raising money, advocating for your company, securing the dollars, and then be told, oh, we don't like the makeup. And sometimes there's no rhyme or reason to it. Now, I'm not saying anything other than it's a process, and you need an expert, somebody to work through that process because it is becoming increasingly challenging. So, let's look at these 6 factors, which combined with the previous 6 are really market-leading factors in getting deals done. One thing I want to point out is that the dynamic nature of listing requirements, keep in mind that when you go to adjust one of the factors in your listing requirements, for example, public float or shareholders' equity, or if you have a conversion that's going to add to shareholders' equity or to public float, that you have to go and adjust each side of the equation. Some people forget and they just focus on shareholders' equity because they're trying to solve a problem, trying to solve one problem, and unknowingly they're creating another problem on one of the other criteria. So you have to be very careful. It's a very dynamic formula that cannot be done by just looking at it piecemeal. It has to be viewed together as a whole. We talked a little bit about the new concentration and distribution analysis. Again, that really needs to be worked through the process. And one of the things we do is we work with NASDAQ in figuring out best practices. We work on a lot of deals as special counsel. We obviously represent a lot of underwriters and issuers. So we're constantly updating our models, updating our spreadsheets, figuring out how to present this stuff to NASDAQ in a way that gets them to say yes. Because that's really what this has become. It's become an exercise in moving pieces around to figure out what gets NASDAQ to say yes on a transaction. Because the rules, the qualifications, the written word don't always tell the whole story. Let's talk for 1 second about gun jumping and the pish-posh transaction. Is anyone familiar with pish-posh here? Does anyone know that transaction in the marketplace? It made big headlines a few weeks ago or maybe a month ago now. So let me set the stage real quick. So pish-posh was a deal that was done by an underwriter out here on the West Coast. They got approval from NASDAQ. They went to price the deal, and the underwriters never opened the transaction, never opened the deal, never cleared the transaction for trading, because when they looked at the order balance, or imbalance in this case, in NASDAQ systems on the day of pricing, there were hundreds of thousands of shares against and 20, 30,000, 40,000 shares for, meaning the order imbalance that you open the stock and it would immediately go to $1 or $2 or 50 cents, whatever the price was. So the underwriter went to NASDAQ and said, hey, we have all these shares locked up. We know where they are. The selling shareholders don't even have shares being deposited. How can this be? Well, there was no explanation. Nobody seems to know how there were so many shares against the deal. So what did the underwriter do? They killed the deal. They killed the deal on the day it was open, priced on NASDAQ, ready to trade. And that took courage, and it's very important, and we applaud them for doing that, because it got NASDAQ and the SEC, coincidentally, to take a harder look at being against the issue, or as some would say, shorting, naked shorting, short selling. Now, nobody knows the mechanics of how this really worked on that deal, and if that's even possible on the new issue, but it got them to take a look, and hopefully they look further into this, because the underwriter had to break an underwriting agreement that they signed and were required to deliver the money, and they pulled the deal because of this order imbalance. And that was a deal that, again, very sort of popular in these current times, given all of the brain damage that you have to incur to get a transaction done. One thing that's also very popular coming up in this sort of market is the reemergence of selling shareholders. We are now seeing in books not just the primary offering, the money being raised for the deal, but selling shareholders being tacked along to the registration statement. Meaning, if you have a float requirement of $15 million and you're only raising 6, 7, 8 million, because that's all the market will accept now, issuers are starting to register their legacy shareholders in the registration statement to be able to reach that $15 million float requirement. So selling shareholders are starting to make a reemergence in registration statements. You had not seen them for a long time, but because deal sizes have been cut, and we're going to talk in a few seconds about some slides and what is the appropriate amount to raise in this market, but selling shareholders are definitely coming back. One other very, very important point, and one that is, a little crazy to some of us who practice, is that the SEC, in a lot of cases now, is requiring that NASDAQ approve your application for trading prior to declaring your registration statement effective, which is the craziest thing in the world, right? Because if you don't price, and clearly you're not going to raise any money, because the whole deal is contingent on going to a higher exchange, New York Stock Exchange, NASDAQ. And if you do price, well, clearly everything's fine, and you can move forward with an effective registration statement. But the SEC is on certain deals, and maybe even all deals now, requiring the NASDAQ examiner to interface with the SEC examiner and tell them they have final sign-off. The problem with that is NASDAQ is relying on the concentration and distribution of this syndicate to say, yes, we like this book. We think these investors are good. They're not too concentrated. They're distributed widely. The problem is, everyone knows who's been in this business, you're not supposed to sell a deal until you have an effective registration statement. So 87 years of securities law turned on its face because NASDAQ wants you to confirm a book pre-effectiveness. That used to be called gun jumping. That used to be penalized or enforced. But now we're working through this process where bankers are put in an awkward position to confirm orders, confirm accounts prior to an effective registration statement. It's wild. We've talked a little bit about a lot of the things that need to get done in order to price a deal. But I do want to say one point on this alignment of numerous constituencies. Remember, when you're doing an IPO or an uplist or a foreign cross list, there's so many constituencies that have to be brought together at the same time. There's the regulators, the SEC, NASDAQ. There's legacy shareholders, bridge holders, management, employees, professionals, auditors, right? We got to bring the auditors together to be happy. And it's like everyone's running on their own track, and they have to pull into the station together in order to price a deal. So the result of all of this is that you really need a quarterback. You need a leader of the transaction. And sometimes that can be a consultant, not always. Most of the time it's an attorney. You need an attorney who's proactive, who basically drives the deal forward, who's an advocate, who's a leader, who can drive progress because the market is so tough to get deals done. And just again, in our business, we are very much driven by data, and we're going to talk a little bit about that here for 3 or 4 minutes and just go over the market, where it is today, and then we'll take a few questions. But we do focus on data. We're one of the only law firms that puts out deals monthly, quarterly, yearly on data for these transactions. We track every uplist, every crosslist, every IPO, every structure, every amount raised, every banker. And we really dig into the details to make sure that when we're told something in the marketplace, we actually know it's either true or false. And I'm going to show you through data that 2022 wasn't as bad as everyone says it is. Now, it felt bad. People in the marketplace, participants weren't particularly happy, especially in the second half of the year, but the data suggests otherwise. So let me just run through this very quickly. So in 2022, for the uplistings and cross listings, there were 55 deals done as compared to 66 in 2021. Not too bad. 2022 wasn't the end of the world as people have described it. The data suggests otherwise. Now, look at the money raised, and I have to get through this quickly, I apologize, but the average offering size in 2021 was 17 million. The average offering size across all uplist and cross list was 12 million. Again, not too bad. What this suggests, the key takeaway, is that deals have been streamlined and deals are still happening, but raising less money. And by the way, 10 of the 15 foreign private issuer deals that happened last year were Canadian, which is a huge market and continues to be a big market. Let's look at this slide real quick, and I'm just going to jump through. If you look at the difference, the far right category in dollars raised really was from the large cap. Again, there are some large caps that do uplists and cross list. They really accounted for the drop. The micro cap and the small cap, or really the micro cap, has remained steady in the amount of deals. Quickly, just by quarter, look at the third quarter of 2022, the best quarter in the history of uplist and cross list, $183 million raised. And look at the fourth quarter, $17 million. We're going to talk about why that happened in 1 second. Let's talk about IPOs real quick. You'll see here, 2022, a little bit off, about 35% number of deals. And again, if you look at dollars raised on the far right, 17 million to 15 million. The market is telling us that smaller deals are in favor, which goes back to what we discussed a few minutes ago, the reemergence of selling shareholders in prospectuses. So you can register your legacy shareholders, register others who are part of the public float, so you can do a primary deal for less dollars, because the market is telling us less is more in this moment in time. Look at this slide. That 25 listings in the third quarter for a tremendous amount of IPOs. Again, historically best quarter, and then the drop-off. And that was specifically related to a couple things. Obviously, the remnants of the Russian invasion, interest rates moving higher, but most importantly, the NASDAQ pause. When NASDAQ in September of 2022 single-handedly paused the market. And we were one of the first firms to actually unpause the market with a deal called Laser Photonics. It happened, a week or two after we ended up doing an IPO, which basically, unpaused the pause. but huge effects that ran through the process. Last slide, and then we'll have a few questions. I just wanted to give credit in alphabetical order, so no one can be upset, to all of the bankers who work in our industry. And there's probably more than this, but these are the banks that we know do a good job, are out there, do good deals, active participants in our community. They want to collaborate, they want to lead. So if anyone has any questions, we're here to obviously talk. And if you want to speak or need an introduction or want to talk to any of these banks, some of them are at this conference today. And then lastly, our team is here as well. We're going to be around. We're in booth 51 downstairs, and that is a presentation. I think we have only a few minutes for a few questions.
Thank you.
So just another lawyer. Thank you, Lulu.
No, but it's actually something you mentioned, Joe. One of our clients is dealing with a problem with short selling, and when you mentioned the Pish Posh deal, it occurred to me, what is NASDAQ actually doing about the perceived short selling? And for example, could you address that with the perception of the Pish Posh deal?
Excellent question. Actually, probably the most important question of this moment in sort of microcap world. I'm not sure is the answer. We don't know. There's a black box. We know that they give it lip service. We know that we've heard directly from people within NASDAQ that they've been coordinating with the SEC. But if you look across the industry, numerous microcap companies are trading well below what they used to be trading. Now, some of that is the bull market of 21 and glutting out the system. But it's a real problem, and we hope that they will, along with other regulators, really once and for all address this point. The answer is nobody knows. And if anyone tells you they know, they really don't know. Because the answer is we are really trying to get them to focus on this point. It's hard, and there's no good answer.
Joe, I want to ask you a quick one. When you speak about allowing old shareholders to sell, does that include insiders? Does that include management? Does that include 144 shareholders? Yeah. Does that include leak-out provisions? Does that also include restricted stock in any other way?
Sure. Yeah, excellent point, Shelley. Yes. So again, getting to that $15 million public float threshold has really become a factor of a lot of different criteria these days. It used to just be you raise $15 million, you have no issue. But because the market and the data suggests that we will only accept smaller deals, and we think the sweet spot is between 5 and 8 million, you have to make up a potentially $7 to $10 million gap of selling shareholders. And those can come from shares that are registered in the prospectus. They can come from legacy shareholders using Rule 144. They can come from notes being converted at the closing, or any other rule or exception or source, as long as they are free trading on day one and your lawyer or whoever is running the deal can prove to NASDAQ. NASDAQ has gotten very smart about this issue, and they are requiring lawyers and others to issue opinions, show transfer agent logs, really give the details behind how you come up with your public float. But we covered a lot here today. I only had 25 minutes. I tried to run through some of the most important factors in these transactions. I'll be around, obviously, all week. Our team is here. I encourage you to stop by booth 51. We love talking about this stuff, collaborating, and having thoughts about where this market and where this industry is going. Thank you all for your time, and I hope to see you around the conference.